All attendees are in listen-only mode.
Hello everyone, and welcome to REMN Wholesale's fourth installment in their TRID webinar series. Today's topic will focus on the closing disclosure. A copy of today's presentation will be sent out to all the participants after the Q&A session at the end of the webinar. If you do have any questions during the presentation at any time, complete a question in the question box on the webinar panel. Also, I've been asked about previous webinars that we've given. If you'd like to see or hear any of our previous webinars, please go to www.remnwholesale.com, go to the resource on the toolbar and click on webinars. Before we get started, I do want to ask a couple poll questions. My first one is, we'd like to see who's joined us today. We're going to keep that poll open for just a couple minutes. Okay, thank you all. I could see people are starting, the votes are starting to come in. And I'm going to keep it open for another 5 seconds. Great, thank you all very much. I'm going to close this out. And we have another poll question for you. So we want to know, what's your current understanding of TRID? Are you an expert? Do you have a good understanding? Do you know enough just to be dangerous? And do you need help with this? I'm going to give this also another couple seconds. Okay, I'm going to close out and I will share those results with you. And you could see we have 1%, someone thinks that they're an expert, which is fantastic. And we have a mix between the rest of have a good understanding and people needing help. So we are here to help. And at this time, it's my pleasure to introduce Frank Perugini, Sales Manager at REMN Wholesale. Frank?
Thanks so much, Pam, and thank you everyone for joining us. Welcome this afternoon. So I just want to say again, thank you. As Pam mentioned, if you guys missed any of the other first 3 iterations of this, the first 3 parts, you can go to remnwholesale.com and you can get in additional info on that, or you can reach out to your REMN Wholesale account executive. If you don't have an account executive not signed up with us at REMN Wholesale, you could again go to remnwholesale.com and get set up with us as well. That being said, I'd like to get the ball rolling. I'd like to introduce Phil Shield, our General Counsel and our Chief Compliance Officer, to get the ball rolling. Phil, all yours.
Thanks, Frank. Thanks, Pam, and welcome everybody. Good afternoon. Before we jump into our first slide about the closing disclosure, I just wanted to share some numbers with you all. 6,825,600, 113,760, 1,896, 79, 11, and 2. For some, maybe that's the commissions that you earn. For others, maybe that's what you hope to earn. But in reality, what those numbers are, 6,825,600, the number of seconds before August 1st. And the rest are just other derivatives. We're actually at 79 days from August 1st, and our hope is that you've been paying attention along the way with the developments associated with TRID. You've attended the webinars that we've hosted, and that you will continue to do so during the next 2.5 months, really, as we get into crunch time. So we're going to jump right in and discuss the closing disclosure today. Some of this information was discussed in the previous webinars. We're going to get a little bit deeper in it today and answer some other questions along the way. As a reminder, the closing disclosure, or the CD, combines the final TIL and the HUD-1. This document will become the standard closing form for RESPA transactions. There are exceptions. HELOCs and reverse mortgages are among 2 of the products that are not going to be covered under the integrated disclosure rule, which means if you offer those products, those will be disclosed using the current forms, GFEs, TILs, and HUD-1s. The consistent goal with the new forms are to provide the information to help consumers understand all the costs of the transaction and the total cash needed to close. The most important and usable information appears first on the form, and the CD provides both new, so there are some new disclosures associated with the CD, but there are also disclosure areas that come primarily from the existing TIL that you'll see on the CD. Just like the LE, the CD is a dynamic form. There are some differences though between the loan estimate and the CD. On the closing disclosure, fees are not rounded. They are the exact dollar amounts because once again, these are supposed to be the final figures that the borrower will be paying at their closing. Similar to the LE, inapplicable disclosures are left blank or sections do not appear at all. For the adjustable rate or adjustable payment programs, those tables will appear or not appear depending on that particular program. And just like the loan estimate, we are not permitted to use NA for any field values. Before we get into the details of the form, we're going to talk about timing. And as we've mentioned before, the timing requirements associated with the closing disclosure is probably the single biggest change that we're all going to have to get used to as an industry. The creditor is generally responsible for ensuring that the consumer or the borrower receives the closing disclosure no later than 3 specific business days before consummation. So there's a couple terms in there that we need to define a little bit clearer for everyone. For the purposes of delivering the closing disclosure, a specific business day means all calendar days except Sundays and legal public holidays. Now, the regulation doesn't call it a specific business day, but in practice, we need to distinguish between the general business day, which is when a creditor's offices are open for business, versus the specific business day, which doesn't make a difference when the company is open for business, which means that it's the same business day definition for everybody. This timing requirement is new, and it will impact the scheduling of all closings. One of the areas of concern is what happens when there are changes to the closing disclosure once it has been issued. There are 3 specific instances in which a change will result in a new 3-day waiting period, and there are only 3. The first is an increase of 1/8 for a fixed rate, increase of 1/8 for an ARM with an initial fixed term and adjustments made in equal intervals. Those first 2 are called or defined as regular transactions. Okay, so 1/8 up, and it's actually 1/8 down too. We're not getting into the down part of it today. It's a little bit more complicated. We also have the increase of 1/4 for irregular transactions. We do not offer at REMN Wholesale any products that would be called irregular, so we're not going to spend much time on it today. So that's the first one. We have an APR variance that occurs. The second is if the loan product changes. Product now has a specific definition for the purposes of TRID, and it is an important one. That means that has an implication to your LOS system and how product is defined and categorized within your system. But for the purposes of our discussion today, if we have a change in the product, if we go from a fixed to an ARM, if we go from a 3-1 ARM to a 1-year ARM, at the very end of the transaction, once the CD has been issued, if that occurs, then a new 3-day waiting period, specific business day waiting period, will be in force. The last is if a prepayment penalty is added. We do not offer any products with prepayment penalties. For those who do, we would hope that this is not something that's just being added on at the end of the transaction and would cause a delay. Don't really think that that's going to happen too often. Of the 3 items, the one that we see most prevalent would be the APR variance. Going through the rest of this slide, if the closing disclosure is not provided to the consumer in person, the consumer is considered to have received it 3 business days after it is delivered or placed in the mail. The note here that electronic delivery will be the preferred method whenever humanly possible, and we expect that you will see that across the industry. The next, a creditor may contract with a settlement agent to provide the closing disclosure on the creditor's behalf. However, in this case, the creditor is still legally responsible for the accuracy as well as any errors or defects. REMN Wholesale continues to analyze these workflow implications, but from a practical standpoint, our expectation is that REMN Wholesale will be preparing the closing disclosure, as will most lenders out there, mainly because of the liability, accountability, and accuracy requirements that go along with the lender. This is a very big difference than things are today. The HUD-1 under RESPA is a document that the settlement agent is responsible for. That has shifted, and as a result of that, the workflow and the preparation associated with preparing the closing disclosure will shift from what we are used to today. Up above, the term consummation is used, and it's a legal term. It's defined under Reg Z as the time that a consumer becomes contractually obligated, and that's a state-based law, and that is practically speaking when the note is signed. Okay, that is, so you'll see the term consummation used interchangeably with closing. Think about it when the borrower signs. That's the 3-day period that we're going back from. Okay. As a note at the very bottom, the settlement agent must provide the seller with the closing disclosure. There is a different version of the closing disclosure for the seller. It is not the lender's responsibility to provide it to the seller. It is, in fact, the settlement agent's responsibility. As I mentioned before, the timing requirements associated with the closing disclosure and the paradigm shift of responsibility from the settlement agent to the lender is going to cause some different changes regarding the coordination of the closing. Okay, so let's talk about this. The requirement that the CD be received by the borrower 3 specific business days prior to closing. It's a paradigm shift, as I said, for the entire industry. It will affect how business and communication occurs with both internal folks, so within the broker company, within the lender, okay, and external parties, all the external parties, settlement agents, realtors, and most importantly, borrowers. Borrowers who are closing today and then go to refinance their loan 6 months from now after August, their closing process will be different. The forms they sign up front and at closing will be different. The timing requirements are different, okay? So there is an entire industry of folks that are going to need to be retrained about how we need to talk, coordinate, communicate these closings so that at the end of the day, the consumer is not adversely impacted because of these rules. As mentioned, all parties to the transaction will have an active role ensuring that correct information is requested, provided, and verified so that the closing disclosure may be prepared both timely and accurately. And we pointed out some of the individuals in the transaction that we think need to really pay attention to these rules. And while they may have thought all along the way, well, it's two disclosures, it really doesn't impact me, the coordination of the closing, the communication with the parties impacts everybody. From a processor standpoint, communication with realtors for changes to contracts and or earnest money, commissions, inspections that may have been completed but not necessarily required. Okay, these types of things that maybe in the past we didn't pay much attention to, we need to pay attention to them now. Communication with borrowers to keep them informed of the timing requirement and having them be active participants in the gathering of the information needed. This to me is all about setting expectations with folks from the very beginning of the transaction all the way through the life of the loan. Closures, both from the broker standpoint and the lender standpoint. The communication with settlement agents for accurate proration, settlement fees, title insurance, etc. And re-verification of this information with invoices. Once again, if we think about this, the paradigm shift. Today, these functions are being completed by settlement agents, paralegals, and so forth. They are still going to be doing this. The difference is they will not be then entering that information into a software system to prepare a HUD-1. They will be communicating with a lender via a portal, via some other online fee sheet, whatever mechanism happens to exist for that settlement agent to collect this information like they do today, then to provide it to the lender so that the lender can prepare the closing disclosure. Mentioning settlement agents again, although the burden of accuracy and delivery now falls on REMN Wholesale, the settlement agent is still very much involved with the transaction, as I just mentioned. They will still have all the same information they have today, and they will need to transmit that information so that we can prepare an accurate CD. And as mentioned before, they're responsible for preparing and delivering the CD to the seller. And just critical areas of focus here to take away from this slide. Setting expectations, as I mentioned. Early communication, often communication. Pre-closing instructions. You're going to see that pre-closing instructions are going to become much more prevalent and important today, establishing communication among all parties earlier in the transaction so that information can be shared and then updated accordingly as we lead into the preparation of that closing disclosure. And then also the accuracy of the initial loan estimate and also having reliable vendors who you can rely on for services, for quoting those services, and who are going to be able to deliver those services at the fees that were quoted initially. Moving on to the actual form. We're going to start off with some very basic principles, and then we'll get into some more details regarding the actual form. Few basics. The most important information is listed first on the closing disclosure. The rate, payments, the cost of closing. As I mentioned before, we have whole dollar amounts with no rounding, and there are decimals when applicable. Okay, figures with decimals would be there. Figures without decimals are not going to be there. Okay, once again, blank fields we never use. NA are not applicable, and sections that don't apply, like I mentioned earlier, if it's not an adjustable rate or adjustable payment, those sections will not appear on the form at all. So let's look at the CD. Okay, we've done all this talking. Now we're going to actually look at what this thing looks like. To me, when I looked at the CD for the first time, the first thing I would say is it doesn't look like anything we're used to today. It doesn't look like a HUD-1. It doesn't look like a TIL. The design of it, it's clear for certain. You know, there's a lot of emphasis by the CFPB to make this form, you know, easy to read for a consumer. And you can see that it's broken up, at least page 1, we have 5 pages, you know, into the main information, so that if I'm a borrower and I'm not going to make it through 60 pages of documents at a closing, and I'm not going to make it through 5 pages of a closing disclosure, if at the end of the day, what was the most important information for me, I should see the most important information on page 1. Okay, so now we're going to go forward and we're going to actually get into some of the details of the closing disclosure, starting at the very top. I'm not going to go through every section because a lot of the stuff is very obvious, just pointing out some of the differences. Okay, so we have a date issued, a closing date, and a disbursement date. Okay, the date issued is when it's delivered to the consumer, regardless of the method of delivery. That is a new date field. Okay, a lot of the information, other information that is on here is going to be here, is what we're used to seeing today. The layout is slightly different, but the basic information is what we are used to seeing today. You'll notice the sales price is there. On a refinance transaction, you would have the appraised property value. Borrower, seller, and lender information. This is a purchase example. And then we have the loan information. And as I mentioned before, the loan product is there. The loan product is also on the loan estimate. And once again, if that loan product changes, okay, once the CD is issued, then we have to reissue, correct it, and then have to wait the 3 additional days. Moving on. So this is the next section. Once again, most important information. Okay, this layout looks like the loan estimate. You can put the loan estimate up against the closing disclosure, and the borrower could easily see what the differences are, if there are any, from what they started with. But if they can't easily figure it out, we have the column on the right, which tells the borrower whether or not there's an increase. You know, can this increase, yes or no? And then further on, we'll see whether or not they actually did increase. Okay, once again, basic information here. In our example here, we have an example with a prepayment penalty, even though we don't offer it, but it is one of the examples out there that will show you what happens if you have a yes answer. It's a dynamic form. If you have a yes answer, there has to be a description of what can change. Later on, if it did change, you'll see how that occurs when we get into additional page of the closing disclosure. The rest of the information here is pretty much basic, so we'll keep moving through it. The next is the section that resembles the TIL. The payment stream. Once again, this is an example with mortgage insurance. So you have mortgage insurance for years 1 through 7, then the mortgage insurance goes away. You have a blank for years 8 through 30. The maximum number of columns you will ever see on a closing disclosure is 4. And that would be for, you know, primarily an adjustable rate or adjustable payment table, not payment table, but a payment transaction. Okay, there's no rounding here. We have exact numbers, which is different from the loan estimate. We will also see here the first time that we have escrows mentioned on the closing disclosure. There is an emphasis across both the loan estimate and the closing disclosure on the disclosure of escrows. So you can see here in the escrow section, we have, it's very simple. Is it in the escrow, yes or no? There shouldn't be any confusion to the consumer at that point whether or not the components, whether it be the taxes, insurance, homeowners association, and so forth, are included in their escrow payment. At the bottom here, we have the cost at closing. Okay, so this, not only do you get the figure, but it gives you the breakdown of where it comes from. And then the detail is further on into the closing estimate. You'll also note here that we've given 2 examples, one for a purchase and one for the refinance. Now, the version that we're using for this particular example is a purchase closing disclosure. But you'll see that when you're dealing with a refinance transaction in the lower section, okay, you have cash from or to, just like you're used to today on a HUD-1, but it also gives you more details about where does this come from, you know, what are the costs, what are the components, where do I go to find out the information, and then what's included in my cash to close. So now we're going to look at page 2. Now page 2 resembles a HUD-1. It resembles page, actually a HUD-1 page 2. We have the loan costs, which is very similar to what we're used to seeing today on a HUD-1. But there are some differences here. We just want to point those out before we get into the details of each section. We have ABC format within each section. So if you look across each section, Section A, Section B, Section C, within each section, the fees are alphabetized. Okay, that's a requirement. The law requires it, and it's done this way so that a borrower doesn't have to search high and far to figure out a particular fee if they're looking for it, if they paid for something. Within each section, the fees must be alphabetized. That is not optional. You'll see also that the numerical sections of the HUD-1 that we are used to seeing for years, 800, 900s, etc., they are gone. stuff is grouped the same generally. There are some differences in the groupings, but those sections that we're used to relying on are absolutely gone. So it's going to take everybody time to get used to figuring out where do I find information on this document when I want to find it. As I mentioned, we have alphabetical fee naming. We also are mentioning that, and this was mentioned in our LE presentation, that the fee naming must be uniform, which means that the fee as listed on the loan estimate has to be the same fee name at closing. And especially in the wholesale context, that's going to cause some challenges because you have fees that are named differently across different lenders. You have brokers that name things differently. But at the end of the day, whatever that LE is listed, however the LE fee is listed, we are bound by it, and that has to carry through all the way to the transaction. You can't call it an app fee up front and then call it an application fee at closing. We also have subtotaling, which is something that we're used to, except a lot of the subtotaling occurs at the top, not at the bottom. And then at the bottom, you're going to see that we have other summaries. If we look at the columns are slightly different than what we're used to today. We have a borrower paid column at or before closing. Okay, the concept of POC, where we're used to putting a POC item in parentheses to the far left, is gone. If you have a fee that is paid before closing, it gets a special placeholder in the before closing column, whether it be paid by the borrower or if it's paid by the seller, it has to be listed there as well. Wanted to also mention here that the LE does not have lender paid compensation. That was brought up in previous webinars. But it is going to appear here. Now, we don't have a great example of it, so we put it in the best we could, but lender paid compensation, okay, from a lender to a broker would be listed as a paid by others item in the paid by others column, but it is part of, and it's listed in the loan costs section. So we're going to look a little bit more in detail at that first section, the loan costs and so forth. And once again, this is similar to the basic groupings that we're used to today, but the layout is different than the way it appears on a HUD-1. And this fees portion is really not TIL stuff. This is more of the information that came from the HUD-1. Once again, based on the same basic structure that's on that loan estimate. So we have points. This A section here, line 1, is the only place where a percentage of the loan amount can be listed as a fee. That is a defined place on the form where it can be done. There's no other place that you can actually do it. The system doesn't allow you to actually do it. The form doesn't have that functionality. So if you have a fee being charged as a percentage of the loan, as an origination charge or so forth, that is it right there. That is reserved for points. Pointing out here that the QM process instituted last year for having to calculate whether or not we have bona fide points or not is not part of this. You still have to do that separately to see if it's a bona fide point for QM purposes. So this is a point that is used to reduce the rate, but is not based on a specific definition, associated with QM and so forth. So what that means is that some additional work has to be done outside of the actual form. This is where you would see other customary fees charged by either the broker or the lender. As mentioned before, lender paid compensation has its own spot over in the paid by others. The next section, we start seeing how the fees are now broken down based on whether or not the borrower shopped or did not shop for a particular a particular service or a vendor. On the loan estimate, it's broken up as whether or not they can or they cannot. Now we have to determine throughout the processing of this loan, did the borrower in fact shop for a particular service? And you'll see once again within here that we have alphabetized fees. This is what we would call, our zero tolerance items, as well as our items above that are zero tolerance. There are new fees here in the zero tolerance bucket that we're used to, items that the borrower cannot shop for. So they're not given a choice, which means that that's a fee that's being imposed as part of the transaction by the lender or the broker, and the borrower cannot shop. The borrower can't shop for their appraisal company. They can't shop, for their AMC or their credit report or their life of loan flood cert. And as a result of that, we are subject to no tolerance there, zero tolerance, which means we have to nail it or we have to cure it. Okay, and that's one of the differences between the bucket structure of tolerance from what we're used to today versus what will happen in August. Then we have the services that you can shop for. Once again, title and other types of vendors and so forth. You'll notice from the title sections, each fee associated with title starts with the word title. Once again, that is a requirement. Then you have a hyphen. Then you have the description of the fee in alphabetical order. If you look at title bills today, it's not the way title bills look like, which means that not only work for lenders and brokers, work for settlement agents and title companies as well. Then we have totaling of those fees. Moving on to the next section of page 2. Fees that we're used to today, we're not going to spend a lot of time on them because, once again, we're used to these fees. We're used to the tolerances that are associated with them. These fees, the tolerance buckets haven't changed much. Where they are in the form changed, but the actual sections, you can see the way they're laid out. Other than the fact they're in different headings, different locations, the basic components of your prepaids and your escrows, your interests and so forth are the same concepts that we're used to today. Wanted to point out about the other section where you basically have the other fees. If we have realtors on the phone, okay, real estate commissions are now down in the other section. We're used to seeing them at the top of page 2 of the HUD 1 with their own defined section, and they don't have that anymore. They're down with others. When they apply, they would appear in the other section. And then once again, we have other subtotals and totals. Within each grouping, you have a subtotal, and then you have a total of, you know, the costs and so forth. So moving on to the calculating cash to close. So this is the top of page 3. The HUD 1 page 3, instituted in 2010, caused a lot of problems for folks. It took a lot of time for people to get used to it. That's, if you recall, where we compare the GFE values versus the HUD 1 values, and that's where we calculate tolerance, whether or not the borrower, you know, shopped from a provider on the list and whether or not it's subject to tolerance and so forth. Because that caused confusing, they got rid of it. Replaced with this. Simpler, yes, but we still have to calculate tolerances. This doesn't do a very good job of doing that for us. So why, on one hand, we removed a section that caused some challenges, the HUD 1 page 3 comparison chart. We replaced it with a section that's easier to understand, but doesn't give us the detail to tell us, you know, what, you know, actually has to occur with a cure and so forth in this area. So it's a good and bad there. As I mentioned before, loan estimate versus the final fee. So the CD value are compared right here for us. And as I mentioned, we talked about page 1. Could a fee change? Yes, no. Well, here we see what did change. Okay, what changed, and if so, you know, where do you go to figure out what actually changed? So that's the descriptive section here. You notice here that this resembles page 3 of a 1003. You know, the transaction details, where we have our earnest money deposit, down payment, and so forth, seller credits, and other adjustments. The section is dynamic. Only those sections that have changes are given further detail. And if a cure is needed for a tolerance violation, it is disclosed here as a lender credit, and the credit itself is shown on page 2. Moving on further through page 3. It's a lower section of page 3 of the CD, and this appears very similar. This really looks like page 1 of a HUD 1 if you think about it. Okay, the layout, the main information on the borrower and seller transactions, the cash to and from at the bottom. This pretty much resembles what we're used to today from page 1 of the HUD 1, so we're not going to spend much more time on it. Just this is one of the areas that's pretty much intact. So I'm going to take a minute here and move away from a purchase transaction and just give you a little taste of what the CD looks like for a refinance transaction. So there is an alternative version for the CD, just like there is an alternative version of the LE for refinances. There's some differences here than what we're used to today, and this information has to be captured in the LOS system so it can be generated onto the CD. So we have the name of the payoff, you know, or in this case the payee, which is not that big a deal, but we have a description. Descriptions are not what we're used to seeing today with this type of detail. Obviously, we are used to seeing the amount. So for all the payoffs associated with the refinance transaction, they all need to be listed here with that type of detail. Calculating of cash to close is moved to the bottom of the page, and you can see that the calculating cash to close section, once again, is simpler than that of the purchase because we don't have earnest money deposits and other, you know, seller credits and so forth to account for. But you can also see that we are required to indicate whether or not we had a change in this value from the loan estimate to the final, you know, figures listed on the CD. And if so, where do I find the details as to what changed, or where does the borrower find those details? I've mentioned along the way when we've gone through sections the discussion about tolerances. Want to just point out a couple things here. We're used to this regime from 2010 with the zero tolerance, the 10% cumulative tolerance, and the no tolerance items. No tolerance is the same as what it is today, things that can change pretty much, you know, without any regard, and that's interest and insurance and so forth and things like that. The 10% cumulative tolerance operates similarly, but I can tell you that it is not exactly the same as it is today, but it's beyond the scope of our webinar to get into how we need to calculate and keep track of the 10% cumulative tolerance, as well as how that ties into service providers and whether or not the borrower shopped or they did not shop and so forth. So It's simple enough, but there was a lot of detail there. And then zero tolerance. As mentioned, there are a couple of changes here. What we are used to is that fees paid to the creditor or the mortgage broker or an affiliate of either are in zero tolerance. Now, if you remember when QM came out, there were some discrepancies about, affiliates of one or the other and whether or not they got counted in certain of the QM calculations. For the purposes here in zero tolerance, it's not about QM. If it's an affiliate being paid of either the creditor or the mortgage broker, it goes into zero tolerance. And the new item, which I mentioned when we talked about appraisal and credit, is that fees paid to an unaffiliated third party if the creditor did not permit the consumer to shop. So we know once again, in practice, there are certain vendors that the borrower does not get to choose regardless. And in those cases, we are held accountable for being able to give that a proper disclosure. And if we don't do it right, then we are going to be held accountable for doing a cure because those are zero tolerance items. So we're going to go back to the closing disclosure, and we mentioned the concept of cure and how does that show up. So you can see here that there is detail associated with a lender credit, and we have to give a description. Okay, so in this particular case, there is a $200 credit for the increase in closing costs above the legal limit. So right here, this spells out in plain English that there is a cure and how much that cure is. And then we're going to just a little bit of detail here about page 3, and you can see the detail when you have a variance. If you focus on the 3 items there where you have variances, you can see, for instance, the total closing cost J. You can see that from the LE to the final figures, the amount went up. So it's plain English. Did this change? Yes, it absolutely did. Well, what changed? Go to these sections, you can see what changed. But we can also tell you that we have a $200 cure here. And then the borrower gets to see where that cure actually gets adjusted into their bottom line figures. Okay, so that's different here. And once again, the goal is for the consumer to be able to not necessarily rely on what the settlement agent is telling them about what happened or what the broker or the lender told them what happened. The form is set up so that it's in plain English and they can see what actually happened. We're going to move on to page 4 of the closing disclosure. So this is the first time that we get away from a lot of figures and get more into text. A lot of information here, but we're not going to spend a ton of time on it just so that we can get through this and get to some questions and so forth. But wanted to point out here that a number of the components of page 4 come from the TIL. Okay, assumption, demand feature, late payment, those are all TIL disclosures that have been incorporated into the CD. There are some new ones regarding negative amortization, partial payments, and so forth. And then you have the entire right section, which is all about escrows. And I mentioned earlier, it starts with the LE, carries over to page 1 of the CD, and then here now to page 4 of the CD. There is an emphasis on explaining to the borrower what is their escrow account. What is an escrow account? What's else? What are the other things that they're called depending on what part of the country? Impound or trust account. What are the components? How do we come up with the figures? Okay, this is an area that the CFPB research showed that people historically, borrowers, are confused about it. They may be confused about it during the processing of the loan. They may be confused about it when they get their aggregate adjustment statement after they've had their loan, for a year or depending on when in the cycle they get it. The goal here is to eliminate some of those questions up front so that the borrower is not surprised and they understand how the escrow account functions. Notice that there's an upper section if there is an escrow account and there is a lower section if there is not an escrow account. In this particular example, we have an example with an escrow account. And then you have a narrative at the bottom, which is not a throwaway line. It actually tells the borrower, these are the hypotheticals of what can happen in the future. Once again, it's page 4. It's kind of small print. Will the borrower read it? We don't know. But at the end of the day, this information is valuable. And hopefully, the borrower will read it. And maybe that'll eliminate a question down the road for yourself or for somebody else involved with the transaction. We're going to just display here for a minute the adjustable payment table and the adjustable interest rate table, or called the AIR table, for one of these examples, just so you can see the type of detail that you have with an adjustable rate mortgage. As I mentioned before, if it's not applicable to the transaction, these wouldn't appear. They wouldn't show up and be crossed out or left blank. They just would be, they do not appear on the form. And depending on the type of mortgage loan it is, the tables may appear independently of each other. Sometimes you have an adjustable payment and not an adjustable rate and so forth. As an example, an interest-only loan with a fixed rate would have an adjustable payment table, but not an adjustable interest rate table because the payment can change but not the actual rate. But you can see the detail here, especially on ARMs, more complicated transactions. Okay, the goal of this is to enhance the other types of ARM disclosures they get so that the borrower can understand. And they can't say, I had no idea when my mortgage was going to change. I have no idea when when the subsequent changes could occur. I have no idea how much it could go up or down, and so forth. That stuff's here. It's plain English. So once again, the goal is to make this more transparent to the borrower and easy for them to understand. Now we're going to get to, finally made it to page 5 of the closing disclosure. So if you'll notice here, pointing out that this is the first place that you see the APR. Okay, so our TIL that we use today, APR is front and center on the top of the form. It's here now, literally stuck on page 5 of the closing disclosure. And I pointed out because while the Bureau has admitted that APR is, let's say, complicated, hard to understand, hard to explain to consumers, and that at the end of the day doesn't have a tremendous amount of value to consumers, it's still important because we still have to do various compliance checks based on APR, rate spreads, HPML, other types of things that are still reliant on an APR comparison or calculation. We still have to designate fees as finance charges, yes or no, but you can notice that nothing on this form tells us that, so that has to be done in LOS. So I wanted to bring it up because the design of this is very different and the look and feel is different than what we're used to seeing in the federal box that we call today on the TIL. But here it is, stuck on page 5. Many consumers may not make it there. If they do, then we'll have another thing we'll have to explain that's new, which is called the TIP. The total amount of interest that you will pay over the loan term as a percentage of your loan amount. I'm not going to spend a lot of time on it today, but it is an area in subsequent webinars that we're going to get into because it's something that your borrowers will see on the upfront disclosure and they will see again on the closing disclosure. There are some other disclosures that are new. We have an appraisal disclosure. We have a liability after foreclosure disclosure, which is a state-specific disclosure. We have contract details, which talks about the note, not the sales contract on a purchase, but the actual contract between the lender and the borrower. And that talks about the note and the mortgage and so forth. And what happens, that you need to refer to these documents if you don't make a payment and so forth, or what is a default. It basically guides them to those documents to say, these are important things. We're not going to spell them all out for you today, but you need to look at these documents to really understand your legal obligations. There's also just a statement about tax deductibility. It's not any type of tax advice and so forth, but there's an idea of saying that there are some tax things that you may want to pay attention to regarding deductibility and so forth. And the last thing, and it's seemingly innocuous, but it's actually a pretty big deal, which is that you have this contact information grid. And if you think about it today, we don't have anything like this on any of the forms where we have all the parties listed in one place with their contact information, with their IDs, their licenses, both their NMLS and their state for mortgage folks, for real estate brokers, their state licenses, for settlement agents, their licenses. And we're going to have to gather this information. We're going to have to be able to capture it, display it, and keep track of it from transaction to transaction. And most people aren't doing that today, so that's another thing. While we've gone through 5 pages of information, a lot of the stuff that's important, that's going to be LOS driven, that we're going to have to learn and relearn and so forth. This stuff, seemingly innocuous, is going to cause some additional work for all of us. The last thing is the confirmation of receipt, same as loan estimate. So if you read the language, by signing, you are only confirming that you received this form. You do not have to accept this loan because you have signed or received this form. So once again, it's an acknowledgement, but it's not saying, yeah, we accept it. I don't know how they do that because that's not part of this form, but that's a discussion for another day. So wanted to spend just a minute on talking about post-closing tolerance cures. Not a lot of time on that today so that we can get to our questions, but as I mentioned before, we still have this concept of needing to do cures. There are some timing requirements regarding when we have to make cures and so forth, but we also have to take into account, which is something that lenders and brokers haven't paid much attention to, is that events that occur after closing. The most common one would be the recording of the mortgage. We're responsible to make sure that the borrower gets an accurate closing disclosure. So if, depending on where you are and how quickly things get recorded, if 3 months after the recorded mortgage comes back, you find out that the recording fee listed on the CD was wrong, well, the borrower gets a new CD. whether or not there's a cure associated with it or whether or not there isn't one, or an adjustment or whatever, even if just because the value is different, the borrower has to get an accurate CD. And there are some other timing requirements regarding cures and post-consummation items that we're not going to get into today, just once again for the benefit of time. So what we're going to do now is we're going to have Pam take over, and we're going to do a little bit of Q&A. Thanks.
Great. Thank you so much, Phil. We did get quite a few questions, and we're going to try our best to answer as many as we can in the short time we have left. Our first question we have here is, what fields are part of the closing disclosure can be changed without triggering a new 3-day waiting period?
Okay, so there's a slide on that, but let me just reiterate that. And once again, once the CD has been issued, there are 3 items that could trigger a redisclosure and a new 3-day waiting period. As we mentioned, the prepayment penalty, which is kind of the throwaway item for many, if the loan product changes, and then the third would be the APR. So while we're not going to enumerate all the different fields that could result in an APR change or other loan components that could result in that, if you think about those items from a standpoint of finance charge items or PMI changes that may affect your payment stream and your APR, that's the real focus on items that could impact your APR and then trigger the subsequent new 3-day waiting period.
So in essence, then, it's any fees that are associated that have an APR could possibly trigger the new 3-day rule.
The fees, and then obviously the other components, mortgage insurance, dropping off, LTVs, things like that, that go into play with the APR and the finance charge calculation.
Great, thank you. Can a lender credit be added at time of closing even though it's not on the original loan estimate for closing costs and prepaid fees?
The answer is yes. I mean, lender credits can be added, but they can't be reduced. Lender credits are treated just like zero tolerance items. Okay, so they are subject to tolerance. So if the original LE has a lender credit associated with the way that transaction is structured, that lender credit cannot go down, or if it does, then it's subject to cure. But it can be added. In this particular case, you're increasing the benefit to the borrower, and that's okay, but it has to be disclosed properly, but it wouldn't necessarily trigger or wouldn't trigger a new waiting period.
Thank you. Another question came in, and it was part of comment. Processors tell me that these changes are just moving the same data around to a new format, and they don't see it as a big deal. What do you think, Phil?
I think that it's an oversimplification of things. I think judging from where the technology industry is today, knowing how much time has been spent participating in webinars and trainings and just kind of these roundtables, that it's a tremendous amount. I know there's data out there as far as how many data elements, how many new fields, how much work has been done and continues to need to get done from on an LOS standpoint, and also as related to the doc providers and the compliance engines and all these various other components. So I think it's an oversimplification to say it's just moving around the same data, and we know for certain that there are data points and displays of information that are different. The tip is the best one right now. It's new. We don't have it there. The way other fees are accounted for, whether or not fees can increase or not, yes, no, the dynamic nature of those are all things that are new and that they're not what we're used to dealing with today.
So a question came in on the closing disclosure. Should the date issued be different, or should be 3 days prior than the actual closing date on the form?
I think that's what you're going to see, yes. I think that's what you're going to see. You're going to have the preparation of the CD, not necessarily the preparation of the entire closing package, but the preparation of the CD 3 days in advance of what we expect that the closing date to be.
Great. Okay, thank you. And then our last question that we have is, some questions came in regarding non-affiliate third-party fees, such as a contract processing fee. Would that go in box A or B?
I have to think about box A or box B, because when I think about those sections, I think about it, a little bit in GFE terms versus terms today. So just let me take a second here and think about that one. If the borrower can, if it's an affiliate fee, I don't think it's going to be in A, B. If they can shop for it or not shop for it, that's the question. Because if you think about it, from an LE standpoint, the fees are broken out by whether or not the borrower can shop, yes or no. Okay, so if the borrower can shop for that service, then it's going to be in one section. If they can't, it's going to be in the other. When you think about that origination section, the charges section, B or C. Then ultimately, when you get to the CD, the question is, did they shop for it? So A processing company, chances are that you can't shop for it, so I don't think it's going to be in either of those. The affiliate twist, I need to think about it a second here. I don't want to hold everybody up here, so we can also answer that because we're going to publish FAQs, so we can take that one and make sure that we've answered it properly today.
Great. Thank you so much, Phil. And just to let everyone know, once again, a copy of the presentation will be sent out after this webinar is over. And also, we will be publishing the frequently asked questions that will be available on www.remnwholesale.com. Thank you, Phil, so much for your time today. Frank, are you still with us?
Oh, I'm still here, Pam. So I just want to say thank you again to everyone. Visit us on REMNwholesale.com with any other questions. Contact your account executive. You guys realize how important it is to get in front of this before August coming around the corner. Really looking forward to seeing you guys on Part 5 coming up on June 4th. So thanks again. Look forward to seeing you guys on June 4th, and have a great rest of your day.